South Africa's inflation rose to a 4-month high in June, climbing to 3% from 2.8% in May, reaching the lower end of the Reserve Bank's 3 to 6 target range. Now, despite the uptick, analysts say there's still room to ease interest rates. Furthermore, Statistics South Africa attributes the increase to rising food and utility costs, while fuel prices continue to fall for a fourth month. Now, the central bank has cut rates in 4 of its last 5 meetings, with its next decision due July 31st, just a day before US tariffs on South African exports takes effect. Senior fixed income trader Christoph Kruger shares more insight on what this means for markets.
South Africa's June CPI came in softer than expected. Headline CPI ticked up 3% year on year, slightly below the 3.1% forecast, but still marking the highest print in 4 months. Core inflation, however, eased to 2.9%, falling below the SARB's lower target bound of 3%. That's notable and rare. On a monthly basis, CPI rose 0.3%, driven by housing, food and alcohol. Transport inflation remained negative, but less so than in May, reflecting June's oil price spike. Market reaction was muted. The South African bond curve firmed modestly. Long-end yields compressed 3 to 4 basis points, while the belly outperformed, with the R2035 and the R2037 both firming around 5 basis points. The rand was steady post-release, hovering around the 17.55 to the dollar area, while the FRA strip showed a subtle shift, confirming one full rate cut by year-end, but no longer pricing in a second. The takeaway? While this print supports a more dovish SARB tone, it doesn't unlock a cutting cycle just yet. Policymakers remain cautious, watching oil, the rand, and obviously